So this week, news as usual, and then the guest this week is Jonathan Maxwell from STCL Energy Efficiency Trust. And I think that's quite an interesting fund, so it's going to be key. I'm quite keen to catch up with how they've been doing since we last talked to them. So news first, though. A few things. Foresight Sustainable Forestry had some news this week, which means it's going to be quite close to being fully invested. CIP Merchant Capital, which is a fairly tiny fund that some people probably wouldn't have heard of, is being bid for. And Standard Life Private Equity has some really good results. Start off with the Forestry Fund. Obviously, it's still very new. One of the disappointing things, I think, probably for the fund is that it's moved to a discount fairly soon after launch and hasn't really recovered that. And there's no good reason for that I can fathom, other than perhaps people bought at the beginning thinking that they could somehow sort of stag the IPO, and that didn't really work. So unfortunately, if that did happen, they think they've made it very clear that this is a very sort of long-term fund and you shouldn't expect too much excitement straight away. Having said that, things are actually moving. So they raised less money than they wanted to, which you think would be disappointing, but the effect of that is because they had a seed portfolio, they're going to be fully invested much quicker than they expected. A big chunk of it is held by a cornerstone investor called Blackmead Infrastructure, and that's a sort of Foresight vehicle that's selling them the seed asset portfolio. As I say, it's gone to a discount, so it's a 7% discount to the offer price. The trouble with that is that it sort of gets a reputation of being sort of somehow disappointing. I don't think that's probably going to be entirely deserved. So one of the things that I think is interesting about this is that it adopted an inflation-linked target. Anything with inflation-linked targets at the moment looks ambitious because inflation is so high, but obviously if you've got, like the renewable energy funds do, some kind of explicit link in your revenue to inflation, then that makes it an awful lot easier. Here doesn't really ring true, but they have put out evidence before, just saying that timber prices, which is the chart on the bottom there, do tend to move in line with inflation, and so does the value of the land that forest sits on. So that gives them, over the long term, some kind of comfort that the value of the fund, the NAV of the fund, is going to move along with inflation. Plus, you've got the kind of natural returns of the fund as the trees grow and then you harvest them. And they also are quite convinced, as in the prospectus, that there's a huge imbalance in the supply and demand for timber. And they quote some numbers that say that demand for timber is going to be 4 times higher in 2050 than it is now. Now, I think whether you believe that or not, that doesn't reflect a sort of change in the way that we build houses, for instance, and some kind of biofuel stuff. It doesn't really need that to work. I think that's one of the important things. So that sort of huge increase in demand doesn't need to happen. The UK is actually deficient in the amount of trees that we grow, which is quite surprising. We're actually one of the lowest forested countries in Europe, and we import much of the timber that we use, and that doesn't seem particularly efficient, really, when you think about it. And for that reason, the government is committed to planting forests. So they're targeting 900,000 acres by 2050. Hectares, not acres. It's a big difference. And to kind of incentivize that to happen, they've set up those woodland carbon guarantee scheme, which is one way of attaching carbon credits to forestation projects. So projects where you're actually planting trees. Foresight is going to reinvest its cash flows, so there won't be much of a dividend. They'll pay the minimum necessary, I think, at least in the short term. Further down the line, it's possible that they might be paying a dividend, but we don't really know what that might be. But they have said they might distribute the carbon credits, and I think this is an interesting angle. So it may be that people can buy this fund as a way of sort of offsetting their carbon emissions. I'm not sure how the mechanism will work in practice, but it just seems that this might be quite a good idea. If you think what the Standard Life Investors Property Income Fund has done in buying a woodland that is going to plant trees, well, a piece of land is going to plant trees on. It's the same sort of idea that you can get in on the ground. And I think this might be a way for individual investors of doing this. So it's going to be interesting to see if that does develop. In terms of the chart at the bottom there, that's just showing you how much more land is planned to be planted in the UK. So actually it's only another 3.7% of the surface area of the UK, but it's quite a big increase in the amount of woodland that we got. So that reinforces the idea that there's going to be quite a lot of investment needed in this area, and it does underpin the idea that this fund could grow quite substantially. They had a seed asset portfolio lined up at IPO. This is what it looked like. But as you can see, it's 138 million, and that's more money than they've got. So they had to do something about that. And they already had a £150 million pipeline. So I think the idea is to raise 200, invest that straight away, and then we'll deploy the pipeline over time. What we've got lined up as of this week are 26 assets covering 8,000 hectares. Just over a third of those are going to be new planting schemes, and the balance are existing standing forests. And that deal, now that they've rejigged it, is expected to complete next month. And then from that point on, it's going to be substantially fully invested. And I think it would be like to expand. So it's going to be interesting to see how they do that. I mean, it may be, it doesn't happen very often, but it may be that investors say, this is exactly the sort of thing I would quite like some long-term exposure to, and it is a very long-term thing, as I want to stress. And they might be prepared to take a hit to the discount up front, so issuing shares at a premium to asset value, but in the knowledge that the shares are trading at a discount in the market. It's going to be interesting to see that. I think that might be possible with this fund, but we'll have to see. I also think it's possible that we'll see a competitor launch, because obviously the asset manager with the big exposure to forestry is Gresham, and they've got the expertise to do it. So if somebody's going to come along and launch a fund, I would have thought it would be them. We shall wait and see. CIP Merchant Capital is tiny, and as you can see from this chart, really not very successful. In fact, its NAV is lower than it was at launch, and the discount opened up fairly soon after it was launched in the beginning, and then just hasn't narrowed again since. And that's remarkable, really. You hear the size of the discount there, because it's already been bid for once. It was launched in 2017 with the idea that it would take significant stakes in small cap businesses and try and influence them for the better. The managers are an outfit that used to work for a family office. I don't like the fact that they're on the board. They're non-independent directors, as that's acknowledged, but they shouldn't really be on the board of the company. There might be one reason why it's not tackled its discount. And one large shareholder, this corporation, Financière Européenne, has got a 31.8% stake in it, which is obviously already over the threshold when you have to make a mandatory bid, which is kind of what happened last time. So they made an approach in December 2020 and bid 50p for it. And the board said, no, you're just being opportunistic. Their share price has fallen because of COVID and, blah, blah, blah. Share price moved by the offer price and CFE walked away from it. But the board did nothing about the discount. And so it's come back and it's now being 55p a share. Because the NAV has gone up 17% since last time they bid, that's actually now a bigger discount to NAV, so 37% discount is what they're bidding. Nevertheless, that was a premium to the price it was trading at before they announced the bid. And although the share price is nudged above the offer price now, it's not much above it. So I don't think it's enough for CIP to say it's an opportunistic bid. They're trying to get the assets on the cheap again, which is the defense last time. I think they've got to actually say how they're going to tackle the discount. If they don't do that, if I was a shareholder, I would be saying 55p is not enough, but if you sweeten that a bit, then maybe I'll say yes and just see the thing disappear. It doesn't really make sense as it is. It's too small and too big a discount and not very successful. So there we go. Standard Life Private Equity is a successful business and actually announced some results this week that are quite spectacular, I thought. So NAV return for the year to the end of September, sorry, of 38%, which was the best that it's ever done, and a 60% share price return as the discount came rattling in, which is one thing that we've been banging on and on and on about. These discounts are too wide, and they also managed to hike the dividend, which is good news as well. It was a good period for exits, as we know, quite buoyant markets. That's helped. So they could get some IPOs away of things that we've seen crop up elsewhere. So Moonpig, for instance, turned up in the portfolio of BlackRock and Morton. Against that, they made substantial commitments to new funds, and they've also been making some co-investments, which is part of a policy change that they implemented a couple of years ago. So making more direct co-investments alongside buying stakes in limited partnership private equity funds. And the beauty of the co-investments is that they come with much lower fees. And so they're investing alongside managers that they like, but they're doing it in a way which is cheaper for the investor. One of these perennial things that always comes up with private equity, they deliberately overcommit themselves, and this is no exception. So that it's got about 30% excess commitments relative to its NAV. That is not as scary as it sounds, because there's a credit facility that's 183 million quid that they haven't tapped yet, which kind of things, and then they will also get exits, which will help to fund for new investments as they come along. It's important that they do this. If they didn't do this, there'd be a cash drag, because if you just hold cash on the off chance that you might get called down, then that doesn't return anything, and that drags down the returns. So I think the worry might be that in more difficult markets, can they actually still achieve the exits? I'll just put this slide in here, maybe slightly out of order, but it just shows you how well it's been doing over the past few years. But one of the things I wanted to emphasize here is these jumps in the NAV through time. The NAV keeps jumping upwards because they keep making disposals, and when they make disposals, they're doing it at valuations that are well above the NAV, and that's fairly consistent, and that happens not just with this fund, but with all other private equity funds too. The NAVs are conservative, and so there is no good reason why there are big discounts, and this is something that we keep reiterating. The discount has widened out slightly in this latest kind of market patch of nervousness, and it's now about to 21%, I think. Yeah, 21.7%. The NAV may go down, as it did a little bit in 2020 when COVID hit. I mean, yeah, it did go down a bit, but really not very much. And if I ran that chart back to the global financial crisis, same thing happened. The share price fell off a cliff and then bounced again, but the NAV had a dent, but not anywhere near as big a dent. The exits that they need to fund their commitments can be achieved without IPOs. Most of the exits that these private equity funds get are selling to other private equity firms rather than selling to IPOs. And those private equity firms are full of cash at the moment, as the commitments for Standard Life Private Equity has made suggest. And so one of the things I think we might see is those things come shopping in the listed market for things that were very expensive and are now a bit cheaper. I'm not saying the markets are now looking cheap, they might fall further, but we could see more private equity bids. And when we get exits, we get NAV uplifts, and the whole thing is running on. So all good.